It's what I think it's worth considering. Let's talk about heart mentality, how it drives, stock price inflation. Heart mentality, its, you know, its effect on stock price inflation. Number one is driving excessive demand. Heart mentality drives excessive demand. Heart mentality occurs when investors follow the crowd rather than making independent, research based decisions. This collective behavior leads to a surge in demand for certain stocks, pushing prices and beyond their intrinsic value. As more investors join the trend, the stock price continues to inflate disproportionately. That's when you consider fundamentals. Number two, amplifying speculative bubbles. Amplifying speculative bubbles. Herd mentality, often fuels speculative bubbles where asset prices rise rapidly due to exaggerated expectations rather than solid fundamentals. This was evident during the dot-com bubble, where investors poured money into internet stocks with little regards for profitability, inflating valuations to unsustainable levels. Anything with .com, xyz.com, abc. Once it carries .com, investors will bid up the price of such stocks. Just, attach .com to a company's name, automatically the price will increase. Mhm. Number three is ignoring fundamental analysis. Ignoring fundamental analysis. When herd mentality dominates, investors tend to overlook, key financial metrics such as earnings, revenue growth, and debts, overall debt levels. Instead, they focus on market hype and fear of missing out. They focus on FOMO, which exacerbates stock inflation and increases market volatility. Number four is accelerating market volatility. Accelerating market volatility. Stocks influenced by herd mentality experience heightened price swings. Rapid buying drives. It drives prices up, while any negative news or sentiments, reverses or triggers a kind of panic selling, leading to sharp correction. It takes the slightest negative news will then bring the party to an end. This volatility undermines market stability and investor confidence. Number five is creating overvaluation risk. Creating overvaluation risk. Please don't forget to subscribe to this channel and like this video. All right, so that I'll be motivated the more to keep on bringing quality content like this to you. So creating overvaluation risk. So hard-driven price inflation often results in stocks becoming overvalued, making future returns less attractive. The more you buy at an expensive price, then it will eat into your future returns. When prices are detached from fundamentals, the risk of a sudden market correction increases, leaving latecomers to the trend exposed to significant losses. Those who are coming late, they'll be left holding the bag when people bought earlier and take profits. They will be left with losses. Number 6 is contributing to market correction and crashes. Contributing to market correction and crash. Actually, hard mentality contributes to market correction and crashes. Hard mentality creates overvaluation risks. Hard mentality accelerates market volatility and it ignores fundamental analysis. Hard mentality, amplifies speculative behavior. It drives excessive demands. There's nothing good nothing good comes out of hard mentality. So once investors in the sentiment shift, the same hard mentality that inflated the price can lead to mass sell-off. It's funny, human behavior, I'm telling you. That's why you must learn to walk alone when it comes to investing. Keep your sanity. This rapid unwinding can cause severe market corrections or even crashes, as seen in the events like the 2008 financial crisis, where speculative buying in the housing market turned into widespread panic selling. That is what really happened. So, herd mentality, in conclusion, is a powerful force that can lead to stock price inflation and destabilize financial markets. Investors can, mitigate the risks associated with herd-driven market movement by focusing on fundamental analysis, maintaining a diversified portfolio, and exercising independent judgment. Learn to walk alone. Learn to think independently and act independently. Learn to make informed business decisions. Because unlike a democracy where the majority, is deemed to be correct, when it comes to investing, you know, the crowd is not always correct. So anchor your decision on company fundamentals. Let the fundamentals be your guide, not sentiment. Sentiment will always change. But company fundamentals, is what anchoring your decisions on.